Welcome to the Deep Dive. Today, we're jumping straight into the Q3 2025 earnings for Caris Life Sciences. They're a really key player in that diagnostics-led TechBio space.
And what a quarter it was. I mean, the headline numbers were huge beats, really foundational milestones for the company. Management must be quite pleased.
Absolutely. So our mission today is simple. Break down the key financial and strategic points from management's commentary, get into the numbers that matter, and, crucially, try to figure out why such strong results led to, well, such a bumpy ride for the stock.
Yeah, that's the puzzle, isn't it?
Okay, let's hit the results snapshot first. Caris, they delivered what really looks like a major inflection point.
The biggest headline has got to be the profitability swing. The GAAP diluted EPS came in between $0.08 and $0.09. And remember, the street was expecting a loss, somewhere like negative $0.11 to negative $0.14.
It's a massive swing, and compared to last year's loss of $2.59 per share.
Exactly. A huge reversal.
And this was built on just explosive growth, right? Q3 revenue hit $216.8 million. That's up 113.4% year over year.
Yeah, and that blew past the consensus estimate, too, which was around $174 million.
So triple-digit growth and a surprise profit.
Right. And it wasn't just the EPS. Management highlighted positive net income, $24.3 million, positive adjusted EBITDA at $51.2 million, and maybe the most significant marker.
Let me guess, cash flow.
You got it. Positive free cash flow of $55.3 million, and that's a first. First time in their 17-year history.
Okay, hitting that kind of growth and flipping to positive free cash flow, that's pretty rare in biotech, especially post-IPO.
Extremely rare, which circles back to that key question you raised. If the fundamentals looked this good, why the market volatility afterwards? We need to dig into that.
Definitely. So let's peel back the onion. What drove the growth? Molecular profiling was the powerhouse, right?
Absolutely. $207.6 million from molecular profiling, up 121% year over year. The pharma R&D side was steady, $9.2 million, up about 18%, but it really cements them as diagnostics-led.
Okay, but here's where it gets really interesting for me. Gross margin. It shot up to 68.0%. That's a massive leap from 43.7% last year. How did they get that efficient so fast?
Oh, it seems structural. Part of it is lab efficiency. Sure, they're getting better there.
Sure.
But the main story, the really big driver, was a dramatic improvement in their average selling price. The ASP.
Okay, ASP. The total clinical ASP hit $4,089. That's up 87% year over year. Huge number.
It is huge, but there's an important detail in there. You need to know about the one-time $37.9 million revenue true-up for the quarter.
The true-up. So basically catching up on collecting money they were already owed, maybe faster than expected.
Exactly. Stronger than expected collections, especially from commercial payers and for prior cases. A lot of that seems tied to the momentum after the MI cancer seek FDA approval.
Yeah.
So that true-up definitely gave that 68% margin a nice boost.
Right. So the critical question then becomes, how much of that margin expansion is sustainable? If we strip out that one-time $37.9 million, what's the underlying picture? Are we looking at an artificially high bar for Q4?
That's the million-dollar question, or maybe the $37.9 million question here. Management did address this. They estimate that even without that true-up, the underlying base tissue ASP still improved ahead of their own expectations.
Okay.
They put that base ASP at around $3,500. So yes, the headline 68% is inflated, but the underlying improvement in payer mix and monetization is real and structural. It's just not quite that high on a recurring basis.
Got it. So real improvement, but maybe temper expectations slightly going forward compared to the headline number. Still, that improved base combined with cost control creates serious leverage.
Undeniable operating leverage, revenue up over 113%. But operating expenses, if you exclude stock-based comp, only climbed about 9.1% year over year. That's disciplined.
Very disciplined. And that's how you get to a positive free cash flow so quickly with that kind of growth.
Exactly. And volume was solid, too. Clinical volume hit over 50,000 cases, up 18.2% year over year. And within that, the blood-based Caris Assure volume accelerated nicely, up almost 66%.
Okay, so the core business is humming. Let's connect this to the bigger picture, the strategy. Management keeps talking about being an AI tech bio platform now.
They really are. CEO David Halbert talked quite a bit about the move they made back in 2018, shifting to whole-exome and whole-transcriptome sequencing, WES plus WTS. He framed that as absolutely foundational.
That's what built their data advantage, right?
Precisely. That data mode is now, over 959,000 genomic profiles, and 660,000 of those are matched profiles feeding their AI. That's a huge asset.
And the vision goes beyond just testing now.
Yeah, Halbert talked about moving beyond diagnostics and treatment into something he called the cleanse, which sounds a bit dramatic, but it's essentially personalized disease prevention, prediction and prevention.
And how do they get there?
This is where whole genome sequencing, WGS, comes in. They're incorporating WGS into their early detection tests. Halbert's analogy was that WGS is the full movie, whereas WES is just the highlight reel.
Interesting analogy. So using that newfound cash flow to invest in the next generation of sequencing for future applications like early detection. What about the current products? Any updates there?
Well, MI CancerSeq, their FDA-approved WES plus WTS test, continues to be central, strengthening their companion diagnostics position. And Caris Assure, the liquid biopsy, seems to be gaining share.
You mentioned the volume growth there.
Right, and it's partly driven by more concurrent testing. About 40% of the blood cases also had tissue tested, and that's up from the mid-30s% range previously. So physicians are using both together more often.
Okay. And any news on the MRD front? Minimum residual disease?
Yeah, they're submitting their colorectal MRD data looking for reimbursement. They highlighted strong performance, 96.3% positive agreement, compared to a well-known third-party assay.
Pretty good concordance.
Very good. And interestingly, they explicitly said they're not currently planning to move their MRD test to WGS. They seem happy with the sensitivity they're getting from the current WES plus WTS approach for that specific use case.
So selective application of the different technologies. That makes sense. And all this confidence seems baked into their revised guidance.
It does. They bumped the full year 2025 revenue guide pretty significantly, now looking at $730 million.
Which implies that 77% year-over-year growth we talked about. Huge.
And volume guidance was nudged up too, expecting 22% growth for the full year.
But you hinted there was a but earlier, the spending side.
Right. Here's where we might see some friction with market expectations. Management was clear. They are reinvesting this new cash flow immediately. They expect Q4 operating expenses to jump up quite a bit into the higher $120 million range.
Okay, where's that money going?
It's funding that WGS push for early detection and potentially expanding sales and marketing now that they have the cash to fuel it. They're choosing long-term strategic investment over, say, maximizing near-term margin beats.
Which sounds smart for the long haul, but maybe not what short-term traders wanted to hear right after seeing that positive cash flow number.
That seems to be exactly it. Which brings us squarely to the market reaction, the divergence. The stock initially popped after hours, maybe 10% or so. Looked like enthusiasm for the profit beat.
Yeah, I saw that initial pop.
But then, the next trading day, it completely reversed and then some. Sold off sharply, closed down almost 16%, wiped out the gain, and dug a hole.
So strange. You have this backdrop where biotech, like the IBB and XBI indexes, are up strongly year to date, maybe 27%. But Caris, even after this quarter, is still down since its IPO back in June.
It's a real head scratcher on the surface. Sell-side analysts still mostly bullish. Price targets are up there, mid to high $30. They see the execution.
So the analysts are cheering, but the market's selling. What gives?
I think it boils down to a few things colliding. One, valuation. Was this seller quarter already priced into what many considered a pretty expensive stock post-IPO? Two, that Q4 OPEX guidance signaled the reinvestment strategy, maybe spooking those focused only on the next quarter's margin number.
Right, the jam tomorrow versus jam today crowd.
Kind of. And three, you likely have typical post-IPO dynamics at play, maybe some nervousness or positioning ahead of lockup expirations down the road. So fundamentally, the Q3 results look clean. The guidance raise is positive. The issue seems more about market sentiment, risk appetite right now, and valuation debates, rather than a flaw in the company's actual performance.
Okay, that makes sense. It's context, not necessarily a red flag in the earnings report itself.
I think it's a fair assessment.
All right, this brings us to our favorite segment. This is not financial advice trade idea where we brainstorm something plausible, if maybe a little outrageous, based on the call.
Let's do it. So the core thesis here is built on that inflection point and critically the balance sheet. Caris delivered the results, and now they're sitting on almost $760 million in cash.
Against relatively modest debt, about $376 million.
Right. And management explicitly used phrases like assessing opportunities for expansion and looking at external opportunities. That's code.
Code for M&A.
Very likely. Now, the recent volatility makes a short-term directional bet pretty dicey, but the cash pile supports a longer-term catalyst-driven idea.
Okay, so what's the structure? How do you play that potential catalyst?
The idea would be something like a long-dated, deep-in-the-money call option spread on CAI. maybe going out 9, 12 months.
Financed how? Those can be expensive.
Financed potentially by selling some shorter-dated put options, essentially betting that the extreme near-term volatility might subside or that the cash balance provides a floor. It's a way to reduce the upfront cost of the bullish spread.
Okay, so a leveraged bet on a future event, funded partly by selling insurance against a near-term crash. What's the outrageous but plausible catalyst you're betting on?
The bet is that the $759 million cash hoard isn't just sitting there. It's an M&A war chest. We're anticipating a significant acquisition announcement within, say, the next 6 to 9 months. Something strategic.
Like what kind of target?
A bolt-on acquisition. Maybe multi-$100 million, easily funded with cash on hand. Could be in the AI space to bolster their platform, maybe adding tech in MRD or something in early detection to accelerate that WGS roadmap.
Yeah, and the idea is that a deal like that changes the story.
Exactly. A meaningful acquisition would fundamentally shift the narrative.
Yeah.
It forces the market to look beyond just the next quarter's PS multiple and focus on the long-term platform value and strategic positioning. That's the kind of catalyst that could plausibly help drive the stock back towards those higher analyst targets.
Interesting. A bet on management using that cash strategically to reshape the story. Plausible, certainly, given the cash and the commentary. Outrageous. Depends on the size and timing, I suppose.
That's the idea. Food for thought, not advice.
Absolutely. So wrapping this up, what's the big takeaway for you, the listener? Caris has clearly demonstrated its core model works. High growth, the West WTS differentiation, tight cost control, it generates cash.
The model is validated. The challenge now is navigating market expectations while they execute on a very ambitious long-term plan, investing heavily in that WGS future and potential M&A.
Right. Which leads us to our final provocative thought for you to consider. Management is betting big on whole genome sequencing for personalized disease prevention. Their big readout, Achieve 1, is expected in the first half of 2026.
Okay, so here's the question. If those results convincingly show that WGS is truly superior to current, less comprehensive liquid biopsy methods for early detection, how fast will payers feel the pressure to cover what will surely be a more expensive WGS test?
And what would that do to the entire competitive landscape in liquid biopsy and early detection?
That's the multi-billion-dollar question hanging out there.
Definitely something to think about. Thank you for joining us for this deep dive into Caris Life Sciences Q3 2025 earnings. We hope you feel better informed.